Mixed trading in Asia as Chinese and US central banks keep interest rates on hold. EU trade plunges as Trump's tariffs take effect, setting the stage for escalating tensions. And we explore how South Africa's chronic unemployment is fueling a wave of entrepreneurship. Hello, I'm Taiba Aydin with the latest business and finance news here on TRT World. Asia-Pacific markets were mixed on Thursday after the People's Bank of China followed the US Federal Reserve's move in extending the pause in its rate cut cycle. The Federal Reserve held interest rates steady at 4.25 to 4.5% on Wednesday, while noting an increase in economic uncertainty as it navigates an economy unnerved by President Donald Trump's tariff rollout. The bank also signaled 2 rate reductions later in the year. US stocks rallied on the central bank's decision, regaining some of their footing from a market sell-off that has been going on since February. The Fed's decision comes against a backdrop of festering tensions between the US and its key trading partners. Meanwhile, gold continued its ascendance to reach a new all-time high of $3,057 an ounce. Federal Reserve Chair Jerome Powell says US inflation has started to rise in part due to the president's levies. The comments come as markets fear that Trump's economic policies might trigger a recession.
It is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation.
Let's unpack this now with Nadia El-Belassi, Senior Market Analyst at Equity Group. Nadia, thanks for being with us. Now, what do you make of Chairman Powell's comments, and how will the Fed's move impact the broader market?
Now, good morning, Taiba. We saw that the Fed yesterday projected a few things. They projected that the tariffs will indeed affect inflation in a negative way, that a lot of core PCE inflation will indeed rise, that growth, the GDP will decrease. The projections have been decreased from 2.7 to 1.7. So that's going to hurt the economic growth of the US, and that's very normal to see while tariffs are happening. The effect on global markets is that obviously when he said that there are going to be 2 rate cuts this year, that's more than one already anticipated since the beginning of the year. That's definitely going to be a relief to the markets. We already saw a rally that's also going to boost gold prices even further. We already saw that gold prices have gained $70 just within 1 week, and that's aside from geopolitical tensions, but they're also going to rally from the rate cut expectations. So that's the effect on the broader market. But economic growth is indeed going to be shattered, and inflation, core PCE and CPI are going to rise.
And as you mentioned, the Fed signaled 2 rate cuts this year. How soon can we expect to see these reductions?
I believe we could see one by mid-year, and that we could see one by end of year, but it's definitely going to be data dependent and depend on the PCE numbers and the CPI numbers. I guess they're not going to be able to do a rate cut as long as they see a jump or a bump in inflation numbers. So as long as there's this upward trajectory of inflation numbers, maybe that when we see a little bit of a slowdown in inflation numbers, then the Fed can then intervene and actually mark down or do a rate cut. This is the only door or the only gap that they have to actually go in the market and do a rate cut.
Right, and has this calmed concerns over tariffs?
I don't think so, because we're going to be hit with more tariffs in April. I think that the key headline for markets this year has been more tariffs, and it's definitely going to be hurting economic growth. I don't think it has hurt. It's cooling anything of the market sell-off. Quite opposite, actually. I think it's actually sparking more market sell-offs. We already saw last week a 10% correction in global equities. So I think this could even spark another correction in global equities, and markets have been on edge ever since the tariff saga has started.
All right, Nadia Al-Bilasi, we will have to leave it there. Thank you very much for being with us.
Thank you very much.
Ukraine will likely take centre stage when European leaders meet in Brussels this week. They're also looking to shape the continent's response to the looming trade war with the US. Alex Kadia reports.
The trade war between the European Union and the United States is about to go into overdrive, with multi-billion-dollar industries from both sides of the Atlantic bracing for impact. The opening salvo in this fight was launched by this man and his administration. Back in 2018, President Trump slapped tariffs on aluminium and steel coming from the European Union. Europe hit back with duties on Harley-Davidsons, bourbon and orange juice. But things are hotting up. Trump's new 25% tariffs on Europe's steel and aluminium industries has Europe instantly responding with levies of its own.
The European Union must act to protect consumers and business. The countermeasures we take today are strong but proportionate. As the United States are applying tariffs worth $28 billion, we are responding with countermeasures worth 26 billion euros.
Steel and aluminium, bourbon, motorcycles, jeans, orange juice, cosmetics, clothes, wood, soybeans and other agricultural goods could all be hit with European tariffs if a deal between the two economic superpowers is not reached before April. For his part, Donald Trump isn't happy and has vowed to continue escalating his trade war if the EU doesn't back down. In a post on his own social media platform, the US president called the EU one of the most hostile and abusive taxing and tariffing authorities in the world, vowing 200% tariffs on other European goods. But the business community is nervous. They say this trade war could jeopardize trillions of dollars worth of trade across the Atlantic.
The message is the same for both sides. The relationship is too big and too important to fail. Of course, there are grievances on both sides. We could improve the relationship. We could reduce the costs, actually, of doing trade across the Atlantic. That's what we should be looking at, not increasing the costs. So I think the two sides need to find a solution that actually avoids a tariff war.
But could this rift present an opportunity for European businesses? After all, if American cars suddenly cost more, that could be good news for Renault and other European car makers.
It's not that simple. Although Renault doesn't sell these cars to the US market, it does sell some of its EV technology, and crucially, to be able to make these electric cars, it buys critical raw materials from the US market. Businesses on both sides of the Atlantic see this spat as a lose-lose.
In 2023, trade between the European Union and the United States amounted to a whopping $954.9 billion. That's 42% of global GDP. Across both sides of the Atlantic, EU-US trade keeps 16 million people in jobs. As EU leaders gather in Brussels, high on the agenda will be ramping up Europe's competitiveness, as its largest trading partner now risks becoming its greatest liability.
For 80 years since the end of World War II, the United States and Europe have gotten closer and closer. Their economies became interdependent and intertwined. The Trump administration is now hacking away at that relationship, and European leaders will meet right here to try and avoid the looming economic disaster. Alex Kadia, TOT World, Brussels.
Meanwhile, the European Union's trade data for January reveals a sharp downturn just 1 month before Trump's tariffs kick in. So what does this mean for the Eurozone? In January, the Eurozone's exports totaled over $250 billion, an increase of 3% compared to $246 billion in January of 2024. Imports, on the other hand, saw a larger increase, reaching over $250 billion, up 7.6% from $235 billion the same month of the year. As imports grew faster than exports, the trade surplus shrank to just over $1 billion in January, down sharply from $11 billion the previous year. The outlook appears even more pessimistic compared to last month, when surplus stood at $16 billion. A closer look at trade relationships with individual countries reveals more significant shifts. The trade deficit between the EU and China grew, widening from $22 billion a year ago to $32 billion. In contrast, the trade surplus with the US increased by $5 billion to $18 billion during the same period. And this shift explains why the Trump administration aims to reduce the US's trade deficit with the EU. Now, the EU is preparing for a new phase in its trade relations with the United States. The EU is expected to announce tariffs on up to $28 billion worth of American goods in the coming month, which will undoubtedly add another layer of complexity to the ongoing trade dynamics. Let's bring in Francesco Rizzuto, Professor of Law at UCFB at the University of East London. Thanks for being with us, Professor. Now, the Eurozone has had a slow start to the year. How is the decline in the bloc's trade surplus impacting economic stability?
On economic stability, very negatively. Why? Because it's essentially creating uncertainty, and when people and businesses are uncertain, they're unlikely to invest, they're unlikely to spend. So, if you like, Mr. Trump has created a little bit of a storm, and we really don't see a clear way out, because it would seem the storm itself is going to blow even harder over the next month or so. So uncertainty, fear, and some in Europe want to back down in the face of a pretty determined Mr. Trump, who appears to be totally unconcerned with the impact that this will have on, after all, America's very, very close trading partner. It's really a break from what we're used to.
Right, and of course this data came in before these Trump's tariffs on European goods. How significant will the impact be on Europe's export-driven economies?
Very, very negative. If Trump carries through with his threats, I would imagine that if you are French or Italian or German, though we've seen Germany's export-driven economy suffer in any event, even before Trump, because of other factors, you would be extremely worried that actually, if Trump follows through with his counter threat and sticks 200% on certain alcoholic goods, for example, you would be very, very fearful of the future.
And what is the likelihood of the two sides agreeing on a trade deal?
It's difficult to tell. It depends on how Mr. Trump feels in the morning and whether anybody can persuade him that this kind of tit-for-tat trade war with the European Union is going to hurt both of us. I really think that he's trying to push, just as he did with the Canadians and the Mexicans, he's going to try and bully his way towards us submitting. And I guess the business lobby in Europe will want us to back down so that they don't lose the level of market access that they have to the United States. But I really do, Europe must not back down, in my view. But how you can negotiate with somebody who really seeks to impose his will, and that's the end of it, is extremely difficult. So I'm very pessimistic over the next 12 months as to, if you like, the way in which European economies develop. Because remember, the impact that increases in defense spending will have, and the impact that increases in German borrowing and spending on infrastructure will have, and in the event the European Unions get their act together, the Europeans get their act together over the Draghi-inspired new approach to competitivity and investment, that's going to take 15 months to 2 years, 3 years to follow through, if you like. So the next 12 months, I'm very pessimistic.
A lot of uncertainty indeed. Professor Francesco Rizzuto, thank you very much for joining us.
Pleasure. Good morning.
Now a quick look at some of the other top business stories from around the world. China's new tariffs on Canadian agricultural products, including a 100% levy on canola and 25% on seafood and pork, take effect on Thursday. This retaliation, worth a total of $2.6 billion, comes in response to Canada's tariffs on Chinese electric vehicles. The move will severely impact producers in the canola sector, where China has long been a major market. New Zealand has crawled out of a shallow recession after GDP rose 0.7% in the last quarter of 2024. That's as agriculture and tourism sectors rebounded. New Zealand is one of the world's largest milk exporters. Increased spending by international visitors boosted activity in tourism-related sectors such as accommodation, restaurants and transportation. Brazil's central bank has hiked its key interest rate to 14.25%, the highest in 9 years, in a bid to fight inflation. This marks the 5th straight increase despite President Lula's calls to lower rates to boost growth. The bank warned of economic challenges and signalled another hike may come in May. In South Africa, the lack of job opportunities linked to rising unemployment is pushing more and more people to start their own businesses. But this surge in entrepreneurship reflects deeper cracks within the economy. Emre Boz has more.
In South Africa, high unemployment levels have been a chronic problem for many years. Since the early 2000s, the official rate has remained well above 20%. But recently, that number climbed to over 30%. That's roughly 1 in 3. Unemployment in South Africa peaked at 33.5% in the second quarter of 2024, before dipping to just under 32% by the fourth quarter. With so few jobs to apply for, many are now creating their own businesses, that is. Among them is Thabang Moshoke, a self-taught hairdresser who opened his own barbershop after struggling to find steady work in the city.
As you are aware, there are no jobs, my brother. You see, I lost my job. The contract ended. I stayed home in the township for some time. I still had the passion for cutting people's hair, because I had no clients or a place to advertise my work, so that people can see that I can cut hair. I really had to take chances and start this journey.
But why is unemployment so high? One key reason is the country's sluggish economic growth. South Africa's GDP remained lackluster throughout 2024. Hovering below 1%. It even dipped into negative territory in the third quarter before rebounding slightly to 0.6% in the fourth. As the economy slows, so too does consumer spending. With declining demand, businesses scale back production and hiring. Another factor is inadequate investment in infrastructure. In 2023, South Africa saw over 330 days of rolling blackouts, the worst on record. With unreliable power supply so chronic, foreign investment has dwindled. To make matters worse, authorities recently proposed a budget that includes a 0.5% increase in value-added tax. If this happens, the cost of goods and services will go up, likely reducing spending across the economy.
With a lot of people, poverty also getting deep. So the argument is that any increase on prices of goods and services will make it unaffordable.
To counter this, the government plans to inject $54.5 billion into improving transport and energy systems. The goal, to boost economic output and breathe life into a struggling economy. Emre Boz, TRT World.
For more, we're joined by Terence Hove in Johannesburg. He's a senior financial market strategist at XNES. Now, Terence, South Africa's unemployment rate remains stubbornly high. Why has it been so difficult to reduce?
Yeah, good morning from Johannesburg, Tabor. I think, as the previous clip showed, the structural issues that South Africa has, which the government is also getting to, are some of the causes. Also, its legacy issues with regards to, the working force and getting a lot of skilled labor into the working force and upskilling that labor force for the sectors that need the most skills. So I think that's where the government is also starting to focus on in terms of turning things around and reducing this unemployment rate considerably in going into the coming years.
And many South Africans are now turning to entrepreneurship. How can small businesses thrive in this tough economy?
Yeah, so South Africa is very synonymous with entrepreneurs. Some of them are quite well renowned as well from many, many decades ago. So I think from that, each business will start off as a small business at some point, and that growth definitely is able to fill certain spaces. So the SME space is definitely one where the government is supporting. They are actually increasing more support, including grassroots businesses that are not necessarily medium, but even at their inception, they've begun in this year, 2025, to invite those businesses to the government platforms where they can offer more support through having some of them registered. For example, the spaza shops, those are quite a contributor to what we would call in South Africa the township economy. That's also an important part of the wider economy, and supporting those small businesses as they are doing now, SMEs, it's definitely going to start seeing a turnaround in the coming, at least in the near term, going into the longer term.
Right. Meanwhile, the government is injecting billions into infrastructure. Will this be enough to create sustainable jobs, do you think?
Yes, there's a lot of infrastructure upgrade that is needed. They are not yet getting to all of it. So far, it's some of the infrastructure. If we look at some of the services through municipalities, there's a lot of upgrade of that infrastructure that's required. And through that, a lot of jobs are created, including, for example, road maintenance. Being part of that. And so, yes, it does help to create sustainable jobs, because in the longer term, the infrastructure still needs to be maintained, as it's not a once-off activity. So there is potential there for it to provide that sustainable employment for the labor force.
Right, and we will have to leave it there. Terence Hove, Senior Financial Market Strategist at Exodus, thank you very much for being with us. Now, Ecuador's fishermen are sounding the alarm after a massive oil spill polluted local rivers, threatening their livelihoods and the economy. Lara Kulachastan has more.
The waters of Esmeraldas in northern western Ecuador have long been a lifeline for fishermen and the local economy. But now they're covered in black oil. A landslide ruptured a major pipeline, spilling thousands of barrels of crude into the river.
So it is no longer possible to fish, but the livelihood, the daily source of income here is fishing.
Seafood businesses are also suffering.
Boats haven't been able to go out. The fishing gear is stained and there's no catch.
Meanwhile, the damage extends beyond the fishing industry and into farming.
I'm afraid my plants will die with the fumes. The river is right next to my crops.
People are also being treated for allergic reactions. The government has declared an environmental emergency as the oil spreads into more waterways. Cleanup efforts are underway, but for many, the damage is already done. And with Ecuador exporting nearly 500,000 barrels of oil per day, this disaster could also hit the country's economy hard. Lara Kulcharslan, TRT World.
The ongoing battle for territory and resources in the Democratic Republic of the Congo is not only compounding a humanitarian crisis, but it's also impacting cross-border trade. Small business owners and truck drivers in Kigali say supply chains have been disrupted. Diana Iriza finds out how they are coping.
This food market in Kigali has long been a cornerstone of the local economy. And for years, the neighboring Democratic Republic of the Congo has offered vendors like Lilian Murerwa a steady stream of income for their small businesses, but not so much these days.
Before the conflict escalated, we could send our goods to DRC with relative ease. But now, with the tensions going on in Congo, I've had to cancel a number of orders. And it's costing me more to find new customers here in Rwanda, who don't always buy as much as the DRC market did.
Truck drivers also rely on cross-border trade between Rwanda and the DRC, which has been disrupted by frequent armed clashes and security threats such as ambushes, kidnappings, and roadblocks.
The situation has changed completely. We used to cross the border with a sense of normalcy, but now you don't know if you'll make it through safely. The roads are dangerous, and many drivers are too scared to even take the job.
Rwanda's official statistics show that trade with the DRC was worth more than $240 million in the third quarter of last year, and goods included mineral fuels, food, and live animals. Major donors, the United Kingdom and the International Monetary Fund, have expressed concerns over the financial impact of the extended crisis. The IMF has said that the extended conflict between the two countries and the sanctions on Rwanda could potentially further strain the economy of the country. The United Kingdom has also cautioned that over $1 billion in aid could be at risk.
War has significant impacts on the economy, politics, diplomacy, and the population, as seen in Rwanda's defense strategy involving military equipment, mobilization, and broader security with Congo, all of which require a substantial budget and affect the economy. Congo has also implemented border restrictions and disrupt cross-border trade.
In the end, both Lilian and Eric are waiting, hoping that peace and stability will return in the region soon. Diana Iriza, TRT World, Kigali, Rwanda.
Well, that's all your business news for now. Thanks for watching.